Welcome everybody. Hopefully you've all been able to join. I'm delighted you have been able to make this webcast today. Hello everyone. Thank you very much for joining us. My name is Simon Osborne. I'm the CEO of IFI Global, which is a research and media house based in the City of London. Fund domiciliation is a subject that we cover as a firm in a lot of detail, but also personally, I've been covering it in one way or another now for the best part of 30 years. After introducing the panel, I'm going to give a short presentation on what we see as the salient issues for US managers in fund domiciliation. Then we will get into the panel discussion. If you'd like to join in, please do take advantage of the Q&A button at the bottom of the screen, and please don't wait till the end. We may have a period at the end just for Q&A. On the other hand, we could equally well just keep on going and try and bring questions in as we go along. Before starting, I would like to thank Jersey Finance very much for sponsoring this event. We are absolutely delighted with the turnout today. It looks like we will have about double the numbers that we normally have at our physical events in New York. And I'm very pleased to see that the majority of the people following this today, I believe, are in the US. So welcome and delighted you can make it. Before starting my presentation, I'm going to quickly introduce the panel, then I'll go into the presentation. We have Deborah Francis. She is partner at Seawood & Kissel's Investment Management Group in New York. She focuses on fund formation and structuring and advises clients on regulatory matters. We have Boris Unifeita, who is also based in New York. He's the founder and CEO of Constellation Advisors, which takes care of the fund infrastructure for managers as they grow their business. He's also director of a number of alternative funds. We have Elliot Revson, who is the head of funds at Jersey Finance, where his role is to define the strategy and direction of Jersey as a domicile and destination for alternative funds. And we have Sean Wilkie, who is a partner at Greyline Partners, also in New York. And Greyline Partners provides compliance services to private fund managers, investment advisors, and various other financial firms across the US and now also in the UK. So I'm going to come to the panel in a few minutes. I'm just going to make some as I say, a short introduction on terms of what we see at IFI Global as the issues going on in fund domiciliation at the moment. Well, after decades where very little was going on in fund domiciliation, we have this extraordinary coincidence of timing, which I'm calling 3 Bs and 1 C. BEPS, Brexit and Brussels being the Bs and C being COVID-19. Any one of those things would be huge. Any 2 of them are enormous. 3 is ridiculous. 4 is just off the wall. But that's the way of the world. That is what has happened. And I'm going to very quickly take us through the headlines in those particular areas. BEPS. BEPS is probably best defined by one of its main authors. It's an OECD initiative, and Pascal Saint-Amand, and he came up with this lovely quote: "The golden era of we don't pay any taxes anywhere is over," he says. It's not really aimed at the fund industry. It's certainly not aimed at the long-only industry because they have what's called the IME, the investment management exemption, but it is aimed at alternative funds, and the more basically illiquid you are, such as private equity, real estate, or even hedge funds, even relatively liquid ones, are caught up in BEPS. Very quickly, 3 areas to touch upon. One is a permanent establishment. That's in BEPS Action Plan 7. There are 15 action plans under BEPS, and it's intended to stop people stop using low tax jurisdictions to book their profits. It will require fund directors in those jurisdictions to show that they really are on top of what's going on. An expert on BEPS at PwC in London says that competent directors will be needed in the jurisdiction where the fund is domiciled in order to anchor it there. Transfer pricing is all about how a company may shift profits around to avoid paying tax. It will require much more reporting, so it might have consequences if it is seen that there's a small office, almost a one-man band office, say for the sake of argument, in Luxembourg, that is generating massive profits for the company worldwide. And then the principal purpose test, you will have to show that you are the principal person of the fund or the company in the jurisdiction where you're based in order to pass the BEPS tax test. Now, BEPS, because of this bizarre year we're in with COVID-19, if this had not happened, COVID-19, you would have been hearing an awful lot more about BEPS than you have done, but it hasn't gone away. And once we get this pandemic out of the way, it will be coming back. For example, this year in Luxembourg, Luxembourg is introducing its principal purpose test, and other jurisdictions are doing the same thing. The US, by and large, isn't about the only country in the world that is not doing that, and that's would have probably happened even if it had been a Democratic administration over the last 4 years. Certainly with a Republican administration, they do see it largely as an attack upon US corporations overseas. Brexit, I could talk all day about Brexit, but the important point for a US audience is that US managers using the UK as their base for Europe are affected by it. There is no agreement at the moment between the EU and the UK, and we are really 1 minute to midnight now in the negotiations. The British have imposed a deadline in the middle of October for an agreement to be fixed. If that doesn't happen, we're going to have a true and hard Brexit with no trade agreement whatsoever, especially including in financial services, and not even equivalents. When Theresa May was Prime Minister here in the UK until a year or so ago, everyone thought that would be the minimum we would get. Equivalence is not that great. It can be withdrawn at short notice, as the Swiss found out, or their stock exchange did last year, but it's a lot better than nothing. At the moment, it looks like the UK is not even going to get that. Whether we do or do not get a deal, there is certainty to be a regulatory divergence between the EU and the UK. That's clearly going to happen. The British have already announced there's going to be a lighter touch AIFMD regime for smaller managers. There'll be a number of other changes coming along too. Meanwhile, the EU is probably going more in the other direction of increasing their regulations all the time. So there is a divergence unquestionably coming. Last point on this slide here about the delegation of portfolio management. It is likely, it's not guaranteed, but it is likely over the coming 2 or 3 years that the EU is going to require funds that are investing in European markets that are based in places like Dublin and Luxembourg to do their portfolio management somewhere within the European Union. Funds investing in the US can do what they exactly are doing right now, or in Japan doing what they are doing, or emerging markets doing what they are doing, i.e. doing the portfolio management from the place where they're investing. But the EU thinks that they should be doing investing for European market, which is huge, like 2 trillion euros worth of business and run from London invested into European markets on behalf of European investors. They want that back if they're not going to have a chance to regulate it. And that's going to be very contentious. Brussels, obviously shorthand being the capital of the EU for all the stuff that's coming out of the European Union at the moment. The EU has what it calls a code of conduct group, which has been demanding substance and transparency offshore from all the offshore fund jurisdictions. And it's got some real bite. The Channel Islands, Guernsey and Jersey passed the test without any problems. Cayman was a little bit slow in getting its act together and was blacklisted. It was blacklisted from February this year until Tuesday of this week. It came off the EU's blacklist on Tuesday. So it's 2 days off it, or announced being off it. It just shows that the EU does mean business when it says it's going to do this. It's not mucking around. And I put here the Cayman dilemma. What do I mean by that? I think Cayman's in a very different situation perhaps from places like Guernsey and Jersey, because the vast majority of the funds that use Cayman are using it because they are from the US, and they're using it because it's low cost and relatively light touch regulation, etc., which is what the US market wants. The EU wants something more substantial from an offshore jurisdiction. At the moment, Cayman's saying, fine, we will implement what you want, because they don't want to be blacklisted again. It's not good for them. It's not good for their reputation, even though not many of their funds are distributed in the EU. But there is another school of thought within Cayman, is that they should just say, get lost to the EU and go back to the good old days of having a lighter touch, lower cost type jurisdiction that will keep the American market happy. And I think that's an active debate going on in Cayman right now, and I wouldn't want to say what will happen in the long term. At the moment, they are complying with what the EU wants, because being blacklisted by 27 European countries is probably not a very good place to be. Lastly, COVID-19, as if we didn't have enough on our plate already, we've got this pandemic, and normal fund governance rules everywhere, doubtless in the US too, as far as I'm aware, have been suspended. They absolutely have been, of course, in Europe. And that has, if this thing goes on for much longer, and God help us, it might, has enormous implications for tax and on the legal side. Basically, what's happened in Europe, whether it's any jurisdiction, offshore or in the EU, is that the normal rules have been suspended. One had always hoped, but by the autumn, when the rules were suspended, obviously in the spring, that by now we'd be getting back to normal and we could all forget about it as a temporary aberration. Well, here we are now coming into the middle of October. Sadly, that doesn't look like it's going to be the case. It's a problem for everybody, but I would say it's an especially big problem for Luxembourg, because Luxembourg, as many of you doubtless know, there's a lot of people who work in the Luxembourg fund industry, live in Belgium, France, or Germany. It's a bit like working in New York City and living in, say, New Jersey or Connecticut. Instead of just crossing the state line, you're crossing the national line into another legal jurisdiction. Now, at the moment, therefore, there's quite a lot of people in lockdown who've been working out of their homes, working on funds that are Luxembourg funds, but they are in Germany, France, or Belgium, and that can cause problems. And unless this matter of COVID-19 is resolved very soon. The last point I'd like to make is that EU fund industry is extremely peripatetic. You have a situation where basically every component of it is almost in another country. You have the investment advisor in London. You have the funds domiciled in somewhere like Dublin or Luxembourg. Service providers are everywhere, often in the same jurisdiction where the fund is. The directors of the fund are everywhere. The investors are everywhere around the world. The distributors across many countries. And air travel has been the oil in the EU fund industry's engine. But we don't know, as we sit here this afternoon, what is going to happen in terms of when we will get back to normal. It is a problem for an industry that is so peripatetic as it is right now, and may well, if this thing goes on for much longer, affect fund domiciliation patterns in the future, on top of all the other things I've already mentioned. Very quickly, before we get into our panel discussion, items to consider for the future. I haven't yet mentioned ESG, which is enormous. JP Morgan forecast that ESG assets in every type of funds to segregated mandates will reach something like $40 trillion by the end of this year. It is transforming the fund industry, and I do think it will have a very significant impact upon fund domiciliation too. I think it's an opportunity for various places, one or two international jurisdictions, to put their hand up and say that they want to become and will become the recognized center for expertise, in the same way perhaps that Cayman is recognized as the center of offshore hedge funds, or Luxembourg for retail mutual funds. I think there are jurisdictions that will become recognized for areas of ESG, and we'll find out about that, no doubt, in the near future. Regarding offshore, with all the insanity going on out there, I think what investors and managers will want is stability in a very fractious world that we are living in. And I do think post-Brexit, there's a very good chance that the UK will start to compete as a fund jurisdiction, as an international fund jurisdiction, at least on the regulated side with Ireland and Luxembourg. Somewhere like Liverpool, the north of England, it's not that far from Dublin. It's much cheaper office rents and houses than it would be in Dublin or Luxembourg. And at least for the UK funds at the moment in Ireland or Luxembourg, there's an argument to be made that some of them could be re-domiciled into the UK in the future. And the Treasury in the UK did look at that matter a few years ago. That issue hasn't gone away. And finally, I'd like to mention that at IFI Global, we are launching a thing called Selection Intelligence Service to help managers find fund directors and to give them advice on fund selection. We are building a database of well-qualified fund directors that have met the criteria we work with in the industry. And we are giving to our subscribers, we're starting to do it right now on a more formal basis, we've done it informally for a long time, advice on fund domicile selection. So that's the end of my presentation. I'm now going to go to the panel, and I'm going to ask them all to make brief introductory comments, and then we will go into the Q&A that I was referring to. Elliot, would you like to go first and give us your thoughts on what you've heard so far? You've got to unmute yourself, Elliot.
Indeed. On the subject of what I'm seeing happen in the world of domiciliation, particularly from the perspective of US managers, as you know, Simon, at the end of last year, we commissioned you as IFI to do a survey to answer that specific question and to look at the key trends in fund domiciliation, specifically from the US and UK market. The report found that the key issues of Brexit, BEPS, substance and transparency have shot up the agenda when it comes to domiciliation decisions, and they're likely to influence decision making for some years to come. From a US perspective, the report also highlighted increased uncertainty, costs and regulatory requirements in the Caribbean jurisdictions, and reporting requirements in onshore, increased reporting requirements in onshore European jurisdictions. But to my mind, the number one takeaway from that report is that investors, and it is the investors who primarily determine domiciliation, want jurisdictions that can offer expertise and political and fiscal stability with a no-change outlook from a regulatory, legal or economic perspective. From Jersey, representing Jersey, we were an early adopter of international substance and transparency initiatives. Because of that, we have that respectability, we have that stability, and we have that no-change outlook, which is supported by world-class infrastructure, and, for example, the second fastest broadband in the world. And for those reasons, I feel we have a very powerful message for the US market.
Thank you. Debbie, can I come to you next? Any comments with regards to what you've just heard, and in general, from your perspective, what do you see happening in fund domiciliation?
Sure, yeah, thanks, Simon. So I would say, I mean, I think, you know, it's definitely an issue that managers are considering more closely, especially with the increased costs that they've seen in Cayman, and also just the additional regulatory requirements of, you know, having to have an inside director, you know, register, you know, the additional AML requirements and training in relation to that, and just making sure that all of that monitoring is done. And so it is something that I think managers are thinking about more closely. I will say that, you know, Cayman still tends to be the, you know, main offshore jurisdiction that we're seeing from our client base. There are some managers, though, that are thinking more about just having a, you know, a Delaware or a US-based fund, to the extent that they only are really going to have US taxable investors in the fund. And then there are a number of, you know, clients of ours that have, you know, significant investors from European jurisdictions. And for those clients, they really are looking at other European options, so including Luxembourg, Ireland. And I would say that, you know, we've recently just did a fund in Luxembourg for one of my clients. And I think the process went more smoothly than the client had even anticipated. And there were, you know, a number of similarities between, you know, US and particular Delaware law and Luxembourg law. There weren't, you know, really significant impediments in connection with the business objectives that they were trying to achieve in relation to this particular investment vehicle, which was more of an SPV, and was making an investment in a European jurisdiction. And so for tax and other European purposes, it was the jurisdiction of choice. And I will say that the process did, you know, kind of open the, you know, the client's eyes to the fact that Europe is a viable jurisdiction, and there may not be as much of an issue as far as, you know, thinking about changes to the documents or even in relation to costs compared to the Cayman vehicles. And frankly, the legal costs were fairly comparable on both sides.
Okay, that's interesting. The costs were very comparable. That's one of the first times I've ever heard that. It's interesting. I thought they would have been much lower in the US. Boris, can I come to you next for any opening broad comments before we get into different subject areas?
Sure. Thank you. And thank you for having me on. And certainly doing a webinar is a little different than being in front of a live audience. I think you've touched upon a couple of topics. And I think what's interesting is I'm not sure we have realized or are recognizing the impact of COVID on how we do business and how we're seeing the world. There's a fundamental shift that dates back to the Industrial Revolution in terms of how the way we work, the way we play and function. And about every 80 years or so, we're seeing a fundamental shift. First is people moving from the country to the cities. Then with the advent of the railroads, people started being more, working in a different way. 1950s, people started leaving the cities. And now we're sitting here in 2020, which is about 80 years since the last big move into suburbia, where people can work from anywhere. They can function almost the way they would sitting in the same room. And the impact of that is unknown, because none of us, the world hasn't seen this just yet. And the regulatory authorities have not caught up and caught on to the impact. And when I say regulatory, it's not just how do you regulate a manager where you have people sitting in New York, Luxembourg, and with the proper offices, maybe sitting in London, and there's no one physically in London running that office. So I think it's difficult to say what that will bring. The way we're seeing due diligence and at Constellation, in addition to, we have over 500 clients, and we launch probably 40 to 60 new fund managers every year. And folks want to be in New York, they want to be in London, they want to be basically all over the world in Asia. And the issue of where do you domicile is always at the forefront. And we're not attorneys, we're not, like Deborah, we're basically more of an infrastructure play. How do you set it up? What's the regulatory regime? How do we make it work? But with this new sort of world that we're embarking upon, even doing due diligence is different. You can no longer show up to someone's office and say, well, I'd like to see your technology room. I'd like to touch and feel the people, because nobody is there. Talking to people even about real estate. Everyone, as I had a conversation this morning with a big four, everyone's sort of consolidating, and some people will never be able to work in the office. So the impact on, and maybe we'll touch upon this during the session, the impact on how people are taxed, how people are regulated, and how people are being viewed all over the world and where they function from, because it's no longer where's your office, it's what do you make investment decisions. And if I'm sitting in Portugal making investment decisions because I used to have an office in London, or used to have an office in Switzerland, how does that work? Where my investor is no longer sitting in France. Now they're sitting some island somewhere, because that's where they like to spend their time. I think all of that is going to have a significant impact on how we work and play. And I think sitting here today, I don't have the answers, and I think that'll come over time.
I'm afraid not only do you not have the answers, the regulators and certainly not across Europe have the answers, because of this, as I said in my short presentation, the rules have been suspended, but I think everyone, including the regulators, are making this up as they go along, hoping against hope this nightmare of the pandemic will come to an end, we can go back to normal, but we'll come back to that. Sean, can I come to you for your opening comments?
Sure, yeah. I think I echo everyone's sentiments on the panel today. I think in terms of domiciliation, we've definitely seen a trend globally towards, more increased regulation and increased tax cooperation, which, in my opinion, really mutes the benefits associated with regulatory and tax arbitrage, for lack of a better term. But the conversation is coming up. I mean, I think the incumbent jurisdictions, right, Cayman, we can use that as an example, right? That's really the tale of, two masters, right? You have the EU dictating, saying, you're going to be blacklisted unless you, install these added protections. And then you have the US, which is largely resistant to the intrusive regulatory structures that are often seen through Europe. And I think we saw that materialize in the private funds law, where a lot of these closed-end funds, impacted private equity sponsors that weren't used to being SEMA registered and having to comply with things like, asset custody and directorships and AML designations and the like. So, those added costs and regulatory expenses, I think, play into the mind of many fund sponsors. That being said, the advantages of being in the incumbent, Cayman has a well-defined, corporate law, which provides predictability of legal outcomes, a sophisticated service provider base, and then also, like was alluded to before, familiarity amongst LPs, which, candidly tends to be the most important thing because it's the path of least resistance going into any capital raise.
Right. Okay, let's go through, there's a number of questions. I see there's questions coming in on the Q&A as well. Let's go to the first question that I sent out to you guys the other day. Is there anything beyond what you've already said that, from your perspective, the three Americans on the panel at least, that you see that's relevant, that you haven't already touched upon in terms of fund domiciliation? Obviously, as Boris says, for all the obvious reasons, it's an extremely strange year with COVID-19. But do you see any particular changes, any particular changing patterns in the way things are going? Or do you think it will carry on much as it has been? Before you answer that, when the research that Elliot referred to, we picked up from a number of, not a lot, but just a few interviews, there was some interest in the US in maybe not using perhaps Cayman so much because of the increasing cost, because of all the regulation that the Caymanians don't want to put on. They've been forced to, for the reasons I gave earlier, because they're trying to meet these standards from Brussels. They don't want it either, but they're required to do so if they don't want to be blacklisted. But that is adding to cost. And as somebody said, when I think it's one of the interviews that I did, someone said, well, the cost differential between being in, say, Cayman and being in Canada, so I think was for a private equity structure. This is from a large New York law firm that does a lot of advisory work in the private equity space. He was saying that he's now seeing a reason to go and put some funds, not every fund, but some funds into Canada for the first time, rather than doing the default thing as has been done for so long and going into Cayman. Anyone got any comments on that? Perhaps Debbie, is worth coming to you first. I know whether you've been, do you ever use Canada? Do you ever look around at sort of other alternatives to the traditional fund jurisdictions in that way?
Sure. I will say we haven't really had anyone, use Canada as a jurisdiction. I think obviously, in addition to Cayman, I think there are some people that are looking at Bermuda as well. There are some lesser costs associated with some of, the fund domicile there. They made a big push, I think, a couple of years ago. It's kind of lessened a bit, more recently, but I think, sometimes the speed at which some of the service providers in that jurisdiction have moved hasn't been necessarily the New York speed that my clients are always looking for, and I think Cayman has obviously, because of their experience in dealing with a lot of managers in the US, they're a little bit more cognizant of some of those needs to act more quickly. So I would say that I haven't seen a lot of people moving more towards Canada. I think, in a cost perspective, clients, like I said, are considering more maybe potentially just doing Delaware, or, if they have significant investors who are based in the EU, or they're going to be making, in particular, a lot of investments in the EU, they're thinking about some of those different jurisdictions. I've had some clients consider potentially, additional domiciles in, England. I think obviously with Brexit, there's some concerns about how that would work. And so I think some people are, kind of even being steered by some of their legal advisors against that until there's some more clarity on what's going to happen there. But I mean, I would say for now, I don't necessarily see people moving away from Cayman. To the extent that their investor base is used to that. I think, a lot of managers at this point are looking to, kind of go with the flow. They have, kind of obviously a lot of things to think about in relation to COVID, as Boris mentioned before, and thinking about how that's going to impact their business and how they can do their due diligence with investors going forward. And so I don't know that they're really, going to be focused on moving different jurisdictions or kind of doing what's outside the norm of what a lot of their peers are doing.
Okay. I see we've got 6 questions in here. there's a couple, but perhaps some are kind of slightly off the subject of what we've been talking about. Some are perhaps on the subject of what we've been talking about. Let me go. I mean, one here is probably maybe for you, Elliot. I don't know whether this is something you would like to answer. If the UK doesn't get a trade deal with the EU, will US managers based in London who want distribution across the Euro region be forced to relocate? I mean, I can have a go at that too, but would you want to take that first?
Yeah, no, I can kick that off. I don't think that US managers are fully aware that UK-based entities will not have access to European, excuse me, to European capital or vice versa in the event of a no-deal Brexit. Even in the event of some form of deal, there will be change, and change brings uncertainty. Jersey is outside of the UK. It is outside of the EU. We have bilateral relationships with each of the EU member states, and we have guaranteed private placement into the UK, which was recently augmented by our regulator, the Jersey Financial Services Commission, to remain in effect in the event of a no-deal Brexit. So if a manager, US manager or otherwise, wants to market on a pan-European basis or to the retail market, then the jurisdiction that they will have to go to is Luxembourg or Dublin, an onshore European jurisdiction. Jersey offers private placement, which is a subset of the AIFMD, and it comes with a lighter regulatory touch. You can private place into each of the EU member states. So because we're outside the EU, because we're outside the UK, we have agreements with the EU, we have an agreement with the UK, we bridge the gap and offer certainty in both a pre and post-Brexit environment. And just to give some greater clarity, by the EU's own statistics, only 3% of alternative investment fund managers market into more than 3 European locations. If you're a US manager setting up a fund in onshore, Luxembourg or Dublin, to market into Europe, you will be fully compliant under the AIFMD or UCITS regime, probably the AIFMD one. You will have full disclosure of the manager's remuneration. And then if you use that fund to market elsewhere in the world, you will still be under the AIFMD regime. Within Jersey, we have an opt-in, opt-out regime. So if you're marketing to the rest of the world, you're outside the scope. If you're marketing to Europe, you have the private placement route, which is cheaper, faster, and more efficient than an onshore route. And that the upshot of that is that for that reason, Jersey has over 183 managers marketing into the EU through private placement, which is a statistic that's grown 76% since December 2015. And the continued growth of that is supported by KPMG's recent pre-AIFMD2 report, which strongly favours private placement. But if you want to take that step further and look into the future, If you look into the future, let's not forget AIFMD2, it's on its way. ESMA's desire for increased EU substance and reduced delegation of management outside of the UK will itself lead to further change, further costs, further uncertainty, and will support the attraction of Jersey to US managers and any other manager outside of Europe who wants to market into Europe.
Can I just add to that before we move on to another subject, to answer the question in another way? There has been just shortly after the Brexit vote, a lot of, there are huge, obviously many huge US institutions with their European headquarters in London, who said that as a result of Brexit, they would be moving good chunks of their business into various EU capitals. In one of them, by the way, if the Democrats win the elections, Jamie Dimon, who could be the next Treasury Secretary, there are others as well. That hasn't happened really by and large, at least so far. I think, on the other hand, a lot of people thought there would be a deal between the EU and the UK, but as I said in my presentation, as we speak this afternoon, that's not looking very likely, but so there therefore could be something. So the likes of the JP Morgans, the Goldman Sachs, the Morgan Stanleys of this world, this is outside the immediate investment management world, may still move stuff, but they haven't yet, which is very interesting. I would say, just in addition to that, that the EU is going to have a really huge problem if they do, as they're threatening to do, curtail delegation of portfolio management for funds that are based in the big, huge two cross-border centres of Dublin and Luxembourg for European funds out of London into, say, Paris or Frankfurt. There's very little investment management activity, relatively speaking, that takes place in those cities. You can't just click your fingers. As I said, there's €2 trillion or $2 trillion of business that's run through London for European investors. Moving that into Paris or Frankfurt or wherever it may be is a really huge exercise, and I can't see how at the moment it could be done. For that reason, it may be a bit of an idle threat. On the other hand, the EU does not like the fact that their money or the widows and orphans of Europeans, Italians, Germans, Frenchmen, Spanish is being run by this unregulated offshore island called the UK, which is returning to the sort of wild excesses of Anglo-Saxon capitalism and is not regulated by Brussels in the way that it has been for all these years. So that is one to watch. How it will go, I do not know. I'm going to change subject completely and ask Sean a question, because you did touch upon it in your intro comments, but with wearing your regulatory hat, Sean, you mentioned the increasing bird regulatory burden. Do you foresee that will have a more of an impact upon domiciliation decisions going forward, or do you think it's not going to affect it, even though people do complain about regulation? I don't know what you've had in the US recently under the Trump administration. You've actually probably had less regulation, whereas over here in Europe we've had much more of it. Do you think that's going to have an impact at all upon managers' decisions about where they go?
Yeah, surprisingly, stateside, we've kind of maintained the status quo in terms of regulatory structure. So there, haven't really been new rules, but there certainly hasn't been a curtailment of the existing regulations. I think this is largely contingent on the type of asset manager. I think, historically, closed-end funds, private equity, venture, real estate, really were not used to operating in a regulated environment, whereas hedge funds and traders really, this is nothing new to them. So hedge funds and domiciled in Cayman had to be registered under the Mutual Funds Act for years now. So that's really nothing new, and the corresponding fees are nothing new. But when you get into private equity and you have, single asset vehicles and special purpose vehicles, and, you get more into this corporate structuring, every time that one of those is deemed a fund needs to be registered with SEMA. That's another, another cost that plays into the analysis. And it really negates the, upside for potential investors. So even for some, I've heard anecdotally that even some tax exempts have opted for a Delaware LLC structure in lieu of a Cayman vehicle, for some small deals just because the benefit, the tax benefit was going to be negated due to these, the excess overhead. So I think, it's come up as a topic of conversation recently, but like I alluded to, I mean, there's, Cayman has the advantage of being the incumbent and being a, well-respected, well-established jurisdiction at this point. I do anticipate that Bermuda and BVI will pick up market share, but, I haven't seen them do it in any significant manner to date. I don't know if any of the other panelists have seen anything different.
I would like you to comment on that, but also particularly the Americans on the panel, you too, if you'd like to. There's a question which is just relevant to this particular topic. Let me just find it again. Said, if somebody is coming through a Delaware feeder, do they really care? Oh, here it is. If US investors are coming in through a Delaware feeder, do they really care if the master fund is Irish or Cayman domiciled? Anyone want to answer that?
So there's a couple of ways to answer this question. They probably should, because the master is where all of the assets are housed. It's subject to the jurisdiction of the local jurisdiction. And whereas it's fairly, benign in most cases, whether it's in Ireland or other jurisdictions, or it's Cayman, costs of maintaining it do matter. Governance requirements do matter. Each jurisdiction is slightly different in terms of their requirements as well. So does it really matter? It's a consideration. It is not going to be the deciding factor. It's going to be a deciding factor as you think about it. And just maybe indulge me for a moment, because I'd like to jump back to the question that Deborah responded to earlier, and she was 100% right. Where your investors are going to not be spooked by your jurisdiction, they're used to Jersey, Guernsey, Ireland. They're used to Cayman. They're now getting readjusted to Bermuda. Canada, we had somebody who wanted to register in Canada, and we just, it's an odd, I'm not going to say, I don't want to offend any Canadians on the phone, but it's different. The rules and regulations in Canada are very provincial in terms of how the funds could be distributed, and local bespoke law firms are actually working, sort of individually in each jurisdictions, and how you distribute it. It's within Canada is also fairly unique. And our client felt that it was just easier to do it in the United States in terms of just placing the whole structure in the United States with potentially having, Cayman master, but it's, they split half their folks between Canada and US. So investors will guide you. No investor wants to say, you're registered there, why? I've never heard of that jurisdiction. And that's going to be an impediment, because the mentality that everyone has is this: everyone wants to do what everybody else does. Is Cayman the best jurisdiction in the world? Is Jersey the best jurisdiction in the world? No, it's there are advantages and disadvantages. You have to consider cost, but it's also where you're coming from, tax rules and regulations, where you could be impacting all that. So it's critically important to understand all that prior to placing your fund with certain jurisdictions, because when you do due diligence, and I've done a fair amount of those over my lifetime, is the first question is, why do you look different? And now there's an explanation from the manager, and it's because. Well, now what's because? Now you're leaving it to somebody's judgment. Well, I'm in the Bahamas. Why are you in the Bahamas? Well, because that's the preferred jurisdiction when you come from Latin and South America. Okay, that makes sense, but you still wind up having your assets through the Cayman because everybody can understand it. So I don't want to just, sort of ramble on, but that it becomes critically important, and you don't want to be the first one hanging the flag. Like, well, I've got it in Canada. Okay, great. Now I need to spend, a couple $1,000, maybe tens of thousands of dollars doing an analysis as to why you're in Canada versus somewhere else.
Okay, thank you. There's questions pouring in. I got one from our pre-prepared list I want to get back to, but I'm going to try to take up more before we do. And I'm conscious of the fact we've only got less than 15 minutes before this meeting ends. So there's one quite broad, simple question that I'd like as many of you who would like to answer. maybe I can come to you first, Elliot, but please others answer. The questions are so varied. We've got some very technical questions, and this is probably perhaps the least technical of the lot. Where is the best place, assuming this is from somebody in the US, where is the best place to put a fund to access investors across the world outside the US? Elliot, do you want to go with that first? Anybody else want to pick that up?
Yeah, I give that a go. Excuse me. And the answer is Jersey, and it's Jersey because Jersey is respected and recognised by the OECD, World Bank, and IMF. It has political fiscal stability. It has a no change outlook in terms of regulatory, legal, and from a regulatory, legal, or economic perspective. We have addressed the transparency and substance issues. We have substance in the 44% of our workforce works in the finance industry. We have opt-in, opt-out AIFMD, and opt-in, opt-out AIFMD stance, tax transparency, tax neutrality, and to make it easier for those managers in Cayman during COVID, we overhauled our LP laws to make it easier to port limited partnership from one jurisdiction to Jersey. And by the end of the year, we'll have similar for LLC.
I don't want to say, Elliot, that I disagree with you because I would never do that publicly. But
I knew a but was coming.
It all depends where the investors are used to making investments through. So if you're looking for Japan, China, basically Asia, Luxembourg is the preferred jurisdiction and has been. Ireland is acceptable. So it depends where you are and where you're looking to attract investments from. Now, in your structuring with your legal counsel, you can think through maybe potentially multiple jurisdictions or having feeders hang off masters in the jurisdictions where investors are happy to come through. But that's the sort of analysis you need to perform. Like generally, Americans don't care. But sorry, Elliot, go ahead. I'm just
going to come back and I'm going to say, the first point I made was that it is investors who determine domiciliation. I totally believe that. I've run funds myself. I totally get that. But as jurisdictions change, as the uncertainty that the report Simon independently produced for us shows that there's increased regulation, increased costs, then so the appetite of the investors change. And the upshot of that is if a jurisdiction becomes unstable from whatever perspective, then those managers will not use that jurisdiction. And if you go back to the early days of hedge funds, you saw exactly that in the move from managers from Bermuda to Cayman.
I couldn't agree with you more. You're spot on that. Absolutely.
Right. I feel very bad. There's so many very good questions which are very technical, and I'm going to skip over those because I don't think we have time to answer them. Maybe we can come back and answer them later by email to those of you. I apologize. I see there's 14 questions out there, and so I'm going to go back in the last minutes. We've only got 10 minutes left to one or two much broader issues to finish this on. And I'd like to go to where Boris was touching upon earlier and make it actually not just only for US managers, this is for the entire world. I mean, people all over the world following this particular webcast. Let's just, and I hate to paint this pessimistic picture, we're now going back to COVID-19, touching upon what Elliot just said, whatever it may be, things do change in the world of fund domiciliation. They haven't done for a long time. But something like COVID-19, the lack of ability to travel could be, if this goes on for a lot longer, that could be a significant impact. And I have to say, I'm coming to you today from a town called Thame, which is just outside Oxford, where the Oxford Vaccine Group is one of the leading three in the world producing a vaccine for COVID-19. And I know some people who know people who are in that group, and they're fairly optimistic about it, but they don't think they're going to be in a position to give anyone, including us here in the UK, even in Oxford, the vaccine much before the early summer of next year. And that's if everything goes according to plan. And there's two other leading vaccine groups that are proceeding. And that's, to repeat, if nothing goes wrong, we could be in, and God help us if we are, but we could be in this situation for an awful long time to come. The international fund industry and fund domiciliation especially has been dependent upon physical meetings taking place in the jurisdictions to show the substance in the jurisdictions of people jetting in and jetting out. By the way, never tell the ESG crowd how this industry works, because the carbon footprint of the average fund must be absolutely off the clock. Luckily, the green movement doesn't know that, so don't tell them. But if this goes on for much longer, we could be in something fundamentally different. I'd love to know what you think. Boris, since you brought the subject earlier, have you got any thoughts? God help us, I hope I'm wrong. I'd love to see a vaccine. Since I partly live in the States, I haven't been able to get to my US home for a long time. I'm desperate to get back to normal, I'm sure we all are, but let's be pessimistic for a second. What happens if we're not? What impact will it have on the structure of the business beyond and including fund domiciliation?
So Simon, we need people like you to help bring back the US economy. So please come back to the US, even if you have to quarantine. I mean, I do think things are serious. I do hope this vaccine will help. I mean, the fact that the US president, got sick with his entire entourage, I mean, I'm not going to comment how careful, not careful he was. But the fact that you can have this vaccine sneak into the White House and basically impact a lot of the senior executive leadership in the U.S., it's unbelievable. I mean, in the UK, we had a similar issue, and these are the best protected, best cared for people in the world. How this is going to impact, I do think. Well, we have also a couple of other forces in the U.S. that are impacting us. We have a tremendously increase in taxes in various states. So you have people fleeing, physically fleeing from the Northeast, and they're going to the South, to Florida, to Texas. You have the same sort of trend from the West Coast, people leaving California because of concerns for safety, as well as concerns for as well as the high tax base. And especially in this day and age, someone could be anywhere. You don't need the infrastructure. You don't need to have the same real estate. You can really, and you could outsource a lot of the infrastructure too. I mean, there's firms like ours. There's lots of other firms who can help you with. You could be sitting in your office, just like we are all sitting. Some of us are at work. Some of us are potentially at home. So we're all sitting in our own offices and trying to, and we could be managing money like a lot of our clients are with their analysts, doing the same thing, and the trading being outsourced, and investments being outsourced, and the brave ones go in and check out companies. But the world is changing. So I think that we're going to see more of that in the future. And when we do get over COVID, and we will, because it's not going to be here forever, I think the way we function is going to be completely different. And the winners are going to be jurisdictions where they could house people who could live and enjoy their life, as well as pay very little tax. That's my 2 cents.
Can I ask you all to answer, others who'd like to, very briefly, because we've sadly just got 5 minutes left and we've got lots more we'd like to touch upon. Any very quick pithy answers from the others to that point?
Yeah, very, very briefly. To the exchange Boris and I recently had, and to his opening remarks, I think one of the upshots of COVID, certainly the response to COVID, has led to managers looking at contingency planning. They've been looking at the infrastructure, robustness, and resilience of their fund domiciles, and the ability of the service providers to weather interruptions. We spoke earlier about concerns about regulatory uncertainty. This particular area brings institutional standards and soundness of jurisdictions into question. Do they have substance? Are they robust? And are they resilient? And that may be one driver for investors to focus on more substantial jurisdictions.
Can I ask you, Debbie and Sean, very quickly, with your clients, how has COVID-19 impacted their decision-making in any way in terms of what they're doing, Debbie?
Yeah, I mean, I think the biggest impact that I've seen is really just, kind of the adjustments that they've needed to make in relation to doing more things virtually. And so obviously their own internal team meetings, if they're not in the office, making sure that there's more connection that way, but also just really with investors. I think, often investors really like to come in, they like to see the office, they like to see, what safeguards you may have from a regulatory or compliance perspective. They want to meet people, to see people face to face and get a sense of really who they are as a person, particularly when you're entrusting, your assets to these people, if you're a fiduciary for your own clients. And so I think that's been the biggest thing that people are struggling with. I've had some clients that have, kind of gone into their offices and videotaped their office so they can do kind of a virtual office tour during the operation of due diligence process to just get investors a little bit more comfortable. And people are doing more things like Zoom or, Teams, just to actually see people face to face so that you can at least maybe artificially get that type of connection that you would normally have in person. But I think that's probably one of the, thing that's been hardest for people, is just kind of having that same connection with investors when you can't be in the same room. And even just the conferences, virtual conferences versus actually going and meeting people, it's not necessarily the same from a networking perspective.
Thanks. And Sean, from a regulatory point of view, how is this going to impact if this goes on? I talked about regulatory suspensions in the international jurisdictions. I don't know what's going on in the US, because you don't have quite the same problem we do with all the jet travel we've got to do in normal circumstances. But you're probably in touch with your colleagues in London about this. I want to be interested to know what you think.
Yeah, I mean, it seems since COVID hit that the SEC really hasn't missed a beat. I mean, we've seen a similar cadence in terms of regulatory exams. Obviously, everything is remote at this point, which was a trend. I mean, the regulators were, I think, outside of Boston a couple of years ago, the chances of the staff coming in and knocking on your door for a surprise exam was almost nil. And at this point, it's obviously not going to happen. So I think that's going to continue. We've faced a lot of questions. What are we going to do? What if we go to a completely remote work environment? How do we declare a principal place of business? So we're getting a lot of those questions. I think for some funds that are also relatively far along in their life cycle, where the founders are thinking about moving to a more tax-friendly jurisdiction, I think COVID has really been a driver to reevaluate, those decisions and actually, kind of force people to make that decision sooner rather than later. So, I mean, we've had a couple funds actually move out of New York where they said, hey, our pedigree has always been a New York hedge fund, but now, given the fact that there are no in-person meetings, it's much less important to be at the epicenter of the financial universe. We're going to relocate to Florida, much more tax-friendly environment. And, everyone gets to see the sun for 300 days a year and 80-degree weather. So
that's the theory. That's where I partly live anyway.
Exactly.
And the hurricanes and the alligators and everything else.
Listen,
it's sadly coming here in the UK. It's coming up to 6 o'clock wherever you are in the world. We're at the hour, I'm afraid. So we better curtail it right now. I just want to thank you all. Thank Jersey Finance again for sponsoring this panel, for their comments, and all of you out there around the world following us today. I apologize to many of you who sent questions in, some very good technical questions. If you haven't done that anonymously, we can try and get back to you in the near future. As I said in my comments, we are launching this thing called Selection Intelligence Service for our subscribers, completely free for our subscribers, where we will be able to provide directors or list a database of directors for people, and also we're going to provide intelligence on fund domiciliation decisions. So again, thank you all. Have a very good afternoon, evening, wherever you may be in the world, and we'll be doing many more of these in the coming weeks and months. Goodbye to everybody.